Ladies and gentlemen of the crypto space, we're live on a Monday, August 14th at 11:45 a.m. for the few people remaining in markets. I mean, the whole point that we've been discussing over the last years is to remain in markets and get a sense of trajectories as it pertains to physics. The markets are contracting. The markets are hurting people. People are losing capital. Is that really what people think? It depends on time horizon. And that's the most important thing that I like to assess nowadays is how the realities of physics are applied to everything we experience in our daily lives, including financial activities. And what do I mean by that? I'll briefly explain. One, everything is cyclical, and everything in physical reality is cyclical in many regards as well. And certainly trajectories, not necessarily cyclical, but they're binary. You always have up or down, left or right, A or B, and there's no such thing as steady state. The closest thing you get to steady state with regard to entropy is like absolute zero, which is not necessarily a practical reality. It's a theoretical uh, state. Zero. I mean, I have empty space, but even empty space is permeated by background radiation, so there's no such thing really as steady state. Our perceptions as a human offer the appearance of steady state, but that's because of time horizon. And notice a great example of that phenomena is like time lapse on plant growth. You look at a plant from day to day, it looks like nothing's happening, but then you do time lapse and you're able to see the remarkable state change that occurs over a more perceivable time horizon. So we'll take a peek at markets to get a sense of their state, to get a sense of trajectory. We'll get a sense of time horizons in play and the cyclicality of markets, and obviously I'll hit all your questions as well. So there's a lot of shit going on, and fascinating is the 118% interest rate change on Argentinian bonds this AM, and obviously what's going on in Japan is pretty crazy, and China is deflating. Considering all the stimulus that they do, they're still in contraction or starting to, or whatever the cycle state is over there. It's contracting, and that's fascinating considering how much effort has been put into it to not contract, and we haven't seen it in years. What's going on, and their system over there affects Japan and Korea and Japan. Well, Korea more so affects Japan, not necessarily vice versa, but Japan affects the world. So, and the world is at a crossroads. And this chart very nicely shows that crossroads. The world, you know, is a manifestation of geopolitical collusion. It's the relationship between central bank policies, and that's not even fully geopolitical. It's really the politicians and how they ally with one another with common interests, so on and so forth. That's what allies do, and that's done by collusion. So the manifestation from that you're able to see in an FX chart, and this 103 line is quite fascinating. Look at the time horizons involved. Look at these bars: 5,110 days, 5,633 days. This is the longest uptrend in the dollar since this dollar index chart became available from a data set. We don't have, clearly, we're not going to have the trough for a long time, but obviously the trough is going to be significantly longer than the most previous one. This is the most previous peak to trough, or trough to trough, and it's literally trough to peak in this cycle. So, you're talking about out here. The next cycle, if this plays out over the next 10, 15 years, 11,231 days. I just pulled it out, and it's just a big number. But trough to trough on the dollar cycle, 15 years. So this is what I was talking about with like RT the other day, like super cycle type narratives. The dollar is, you know, allowed to depreciate over the next 10, 15 years. Um, you can have asset price inflation unlike anything you've ever seen. Now, why would the dollar depreciate over the next 15 years and how? It would have to be a manifestation of geopolitical collusion. There's no way organically the dollar is going to depreciate to such a degree over such a time horizon. But there's a reason why we have these two previous cycles from a dollar perspective. It's all geopolitical collusion. Why? You got to kick the can down the road. Kick the can down the road with regard to dollar demand on the planet. And the dollar demand on the planet indicates that this chart is pretty much just up only, considering the dollar debt on the planet. You need more dollars in order to service more debt, and to refinance, you need more dollars. And for any of the countries around the world that are, which is all of them, that are dependent on dollar-denominated purchases, the demand just goes up. So how does the U.S. handle dollars over the last decades? By importing, and that was the globalization trade, where we're importing things and exporting dollars, and that's how the world got dollars. But peak globalization, many argue, and I think is quite a reasonable statement. So the biggest export of the U.S. for a long time now is the exporting of treasuries, of debt instruments that fuel collateral, and collateral is future dollars. So it's used cyclically to print dollars using the Eurodollar regime. So either it's dollar liabilities, it's not really paper dollars, it's a that's how the commercial banking system works. It's an IOU dollar, and collateral exports, which ultimately is used to print dollars. So it's all about dollars. So we're at a crossroads. We're at the 103 line, and this is the monthly chart. So when I see this chart, I see just a fascinating history of interactions with the 103 line. You got interactions with the 103 line back to August of 74. You got a temporary breach of the 103 line here, and an invalidation. You know what? Why I print the 103 line is particularly because of 2020, a weak interaction in 17. You got interactions here in 99, an interaction here in 89, and obviously a very clear interaction here back in 74. But every time we get to this point, there's an invalidation. So I don't know if that's just a coincidental manifestation, of technicalities. But look, you breach it, and it took years. It took, you know, here, look, breach of 103 to peak. Um, we want a date range, so we go from breach of 23 to peak. It's 5,001. No, that's not it. It's up here. 1,400 days. It's over 3 years ish, 3.5 years. So that's fascinating. So this goes back to trajectories. The time horizon to see this trajectory is you need to slow down inspecting data, because if you look at the too short a time horizon, you see the volatility, and it's big volatility. 120, 114 down to 102. That's big volatility. And then for the volatility, for you to get a sense of volatility, I have two circles over here that represent our crypto bull markets. This is everything that you've experienced in crypto markets. That's how big of a time horizon we're inspecting on this dollar FX chart that tells us so much data about the way the world works. This is your bull markets. This is everything that you've ever experienced with regard to significant appreciation of either Bitcoin, Ethereum, or various altcoins that have respective cyclicality, longevity, and survivability characteristics. That's it. That's it. It's part of a secular uptrend, a bull market in the dollar that started in 2008, and that they maybe have control over at this point, geopolitical collusion considered, to put in a top Why? Because of the global debt composition. The dollar has to come down, so foreign fiat actually can exist. When the dollar goes up, that drives more and more capital into the dollar because they need the dollar and their currency's getting cheaper, so they're trying to get as many dollars as they can before their currency just loses more and more value. And at some point, the only way the dollar goes down is the powers that be coerce it to go down. So, that's why we're at such a crossroads from a monthly standpoint. Look at the TWAP. You got a rounding top, and obviously I look at the 3 month and the 6 month, but we could zoom in for the fun of it on the daily. So this is actually meaningful. As much as I don't like to zoom in on the daily, we have lower lows and lower highs, which is what's the trajectory on that? That's downward trajectory. And look at the interactions with the 103 line, this magical 103 line. And notice how even on the daily chart, it hit 103 back here for like a day in March of 2020. That was it. And then geopolitical collusion engaged, and they were able to get the dollar to depreciate for the period of time. And this is our bull market. The circle. That's it. So, breach to the upside, invalidate. Breach to the upside, invalidate. And look at this. On the daily chart, we just had a spike to 103.45, and it pushed back down below 103. So, just as we're looking at the macro invalidation of the 103, that took 3 and change years back here, took 3 and change years back here in the 80s. Zoom in on the daily, you kind of see overtones of that reality. You have the breach of the 103 to the upside, the invalidation. Breach of the 103 to the upside, invalidation. We just had a breach of the 103 to the upside. Let's see. Will this take a month? Will it take a half a month? Whatever. How long will it stay above 103 until, we'll see. Because we know if the trajectory is up, up is the death of foreign fiat currencies, which we've seen various fiat regimes literally either hyperinflate or fail, and failure implies chaos in a respective country where if money doesn't have value, it's literally a war zone and chaos, which is why? Because that's a fight over natural resources, because you don't have a currency that's able to get you natural resources, and that's where conflict breaks out. Always remember that currencies are a way to ration finite natural resources. So my expectation is depreciation, but it takes time. And the time horizon, it's not just patience, it's also understanding why the time horizon is reasonable. And you have to have patience to wait for the time horizon to play out to get a sense of directionality. And look, if you saw the breach of 103 to the downside back in February of 23 and it's pushing back to the upside, you don't have the benefit of hindsight where we are now, but it fell back down. It was invalidated. And then a second time it was invalidated. Cyclically, if we see over the next day or two, maybe it punches back up again, and then we see a higher low, and then finally a retest, and it gets to like 102.978, and then a lower low. That's the trifecta of bearish confluence. The breach of the holding, the breach of support, into and the flipping of it into resistance, and then the lower low. It's the opposite of the trifecta of bullish confluence. So I'd love to see finally getting below 100 cyclically, and this is obviously cyclically. We had the retest to the upside, and then we finally print the lower low. So every time you breach with a lower low, that's further confluence suggesting directionality continuation. So there's reasons to speculate that we have a relatively stable international liquidity environment heading into next year, which could imply there's forced selling in U.S. markets, but international conditions have more stable and more cushiony liquidity conditions. But that's an isolated market. U.S. markets are isolated, and we're much more interested in the global picture, the global tapestry, rather than just U.S. equities. If you really want to understand U.S. equities, I would probably be looking at the bond market, which is what everyone's screaming about this morning, getting up to 4.2, but it quickly fell down. I've stated many times on social media that the raising of interest rates is designed to force people into buying U.S. debt instruments. So at some point, maybe it goes crazy, 4.5. If you saw 4.5 on this chart, what would be going on CT, crypto, Twitter, and social media? Woo! Macro folks would be starting to get very apocalyptic. But then cyclically, you see this will cycle. This is inevitable to cycle. We got to zoom out more to get a picture of this, where it will cycle. My expectation is downtrend invalidation. So I would see something like this. You see your solid downtrend for years, but then I would expect something like this, higher lows. And then over the years is the higher high. And then obviously it brings into all sorts of questions of sustainability and then what it means from an economic structural standpoint and the debt and the interest servicing considerations. But that would be my expectation. That'd be crazy to have a bull market in equities and risk assets over between 24, 25, maybe Q1, Q2, 2025, based on a bond market move in Q1, Q2, 2024 down to 2% from where we are, 4% to 2%, because we've never seen that. We've never seen structurally a higher low on the bond market in our lifetime, in anyone's lifetime that's still alive right now. Maybe the oldest of the old. Higher lows. You talk about the 70s. Who was engaging with markets in the 70s and 72 and then 61? Peter Brandt. Many others, but point being, this would be a structural change to the behavior of markets, higher low on U.S. bonds. So generally, that's my expectation. I expect international liquidity conditions to remain relatively calm, and I expect U.S. equities at some point to risk off into the U.S. bond market. And U.S. equities isn't just U.S. investors, it's the world. The world piles into U.S. equities. So I see very much the case for a significant drawdown, at least in the primary indices, where that's obviously a crowded trade. It's all piled in. If you look at equal weight, U.S. equities have gone nowhere for a long time now. So I expect the crowded trade to get force sold, huge losses. It'll be all over social media that NASDAQ and S&P are crashing. But that's only just a couple of stocks at this point, considering the concentration, the composition of those indices. And as those are sold, equities, U.S. bonds are bought hand over fist, and U.S. bonds are the precursor for offshore dollar printing. Because what are you going to do with the bonds? What does the world do with the bonds? They print dollars. That's what you do with them. So the more the bonds are bought is setting up the cycle of liquidity to go even higher. Because now there's going to be that much more synthetic dollars, dollar liabilities in circulation, as those bonds are used to print dollars in the subsequent quarters. Your 3-month intervals is the time horizon that needs to be considered. Hope that helps. So heading into the Q4, which is September, October, November, December. Q4 2023, Q1 2024. Why not? Equities risk off into bonds, setting up Q2 2024. An enormous amount of U.S. debt is now in possession of the market, and then they get complacent, and then the market turns in equities and crypto, and they're like, oh shit, we need some currency units. Oh, we just bought trillions of dollars worth of bonds. Let's print some currency units, and let's get the risk on. Q2 2024, Q3 2024 should be interesting from a global liquidity standpoint. And that's not the short term. Q4 2023, Q1 2024, I expect the potential for significant volatility from a U.S. equities market perspective. I don't expect much volatility from a crypto market perspective. What kind of forced selling can we expect? We can have an issue with regard to counterparties. Who are the counterparties that drive a lot of the Bitcoin price action? That's Tether and USDC and whatever the remaining composition is of like Binance liabilities. And those are the same issues that we've seen with banks. It's balance sheet composition because all those entities um, are just portfolio managers. They have HTM components of the portfolio. They have investments parts of the portfolio. So it's kind of like a hedge fund in many regards. And if they have balance sheet complexities, then their actions introduce counterparty risk. And personally, I don't have really any exposure to that counterparty risk right now, other than knock-on effects to maybe the Ethereum price. I don't even have much exposure to the Bitcoin price, considering those what I just stated as my observations for risk. I think Ethereum is quite interesting, considering it's not the same liquidity source as Tether. And not that I have a negative opinion of Tether. I like what they do from a historic Eurodollar business perspective. But that's exposure to traditional finance and those types of risks. But Ethereum is not necessarily in the same situation. Ethereum is a market, an emerging market, and we look to the dollar liabilities in that emerging market and the composition and the flow in and out of those dollar liabilities. And what's occurring starting now and heading into the future is the collateralization of on-chain assets to print our own dollar liabilities. So Tether will have an effect, but I think the composition of the DeFi markets is changing with regard to dollars. And that will be interesting to see heading into Q4 2023, Q1 2024, how that composition of dollar liabilities changes. So where can you go to see that composition? Please inspect the stables page on DeFi Llama, and I look forward to seeing this change over time. Definitely want to see Tether dominance come down. I think that'll be healthy. Right now, there's too much concentration, which means that it'll have an outsized effect on the market as if this composition changes, if this quantity changes, they have an outsized effect on the markets. And I'd like to see stuff like Frax as V3 comes online and Liquidity. I'd like to see that go up significantly. CRV USD, I'd like to see that 10x from here, and that's still not going to really budge the overweight effect that Tether has on the market. But that should be a foreshadow with regard to directionality. If those increase 10x on the total supply, what happens over the next 5 years? Then you could potentially see significant rebalancing of the composition of stables within the DeFi space. So you see the time horizons I was just talking about, quarters. And that's why really 6 months and 1 year intervals from a bond market especially are the most meaningful to inspect. 15 people in the stream, 9 likes. I appreciate all of you that have remained in markets. This is the appropriate thing to do. And you manage risk to your portfolio with regard to position size and composition. Stables are meaningful. Dollar liabilities in a bank account are meaningful, but what most meaningful is overhead, capacity to service your monthly obligations, and having assets that expose you to this cyclicality of liquidity conditions from a 3 month to 6 month time horizon perspective. And I think this is certainly the place for capital. Koimi Cookie, yo, got you live. What's up? Another day, another day. trying to keep everyone cool, calm, and collected. And I've found a very nice comfort zone for engaging with markets. I don't have much anxiety at all. I have an expectation of a certain amount of income on a weekly basis, and I know what to look at rather than total portfolio composition and price points. And I don't really consider that. That doesn't weigh too much on my sentiment. I focus much more on cash flow nowadays. I sound like a traditional dividend investor. What's up with Aura price point? That's unfortunate. This is something that caught my eye this morning. Buck 16 pushing for fresh lows. That's heck of a downtrend. You know, it pushes below historic, a dollar. Where's the sterilizers? We need much more consumers. And that's something we certainly saw with what Curve played out. Was that a bullish issue with regard to liquidation threat, as well as uh, poor functionality at the compiler level? Was that a bullish occurrence? The distribution of what was the net result? The distribution of vested interest, and and we still have plenty of recyclers coming online, and I expect that to continue into the future. What we need to see is recyclers. That's like liquids coming online for Bunny. It's just a start. You know, that has overtones of fracs coming online for Curve that stabilize circulating supply and excessive dilution. Um, that'd be nice if we start to see more sterilizers come online for Bunny. That's meaningful. Uniswap has a big part of service and functionality to the DeFi space. I don't think it's the whole picture. Obviously, there's a landscape of what is most meaningful in the coming years, and I would like to think that Aura and Balancer show strength in the coming years, but the chart says you need more sterilizers. You need more deterministic buying. So we'll see what happens. The chart tells the story, and we just interpret it. Sir Joe, President accounted for. Sir, yes, sir, pleasure. JW, what's special about 103? That's an excellent question. So look at that, 102,991. You know, I don't know what's special. If you had a microscope on sovereign nations and a microscope on literally that kind of political conversation between countries and the State Department, I don't know. But in the technical data, look at what happened in March of 2020. Look what happened 17. And if you roll that line back to 2000, it was invalidated. Is that a wick? Look at this. Look at that interaction right there. In 99. Look at that. That's just rolling back to 103, and 103 in 2020, that was the top. That was, if you could zoom in all you want, that is the Pico top. And then if you zoom out, you see a tweezy top in 16 and 17. This is the monthly chart. You see the interaction back here in 99, the breakout, and then the invalidation over 3 years between 2000 and 2003. I've learned in engineering that the reason for an issue is not necessarily more important than actually producing a solution to a bug or a feature. Progress and moving forward is maybe more important than understanding why things occurred. Velocity is what we talk about from a dev perspective. So what is special about 103? Other than what it tells us on the chart, it tells us something is meaningful about 103, whatever it may be, but it screams to us time and time again over the years. This chart is very hard for humans to digest, even myself, everyone. Look at it's going back decades. This was a different world in the 80s, the 70s. Every decade is a different world. But this chart data spans these different worlds, and it tells us there's a commonality between geopolitical response when we get to this particular price point, all the way back to 74. And obviously, the dollar that we have right now is the post $71. The dollar has had different forms over the last 100 years, and we're still operating on basically the post $71. You might call it the dollar, but it's been a very different dollar over the last 100 years. So this dollar that we are inspecting right here in this chart is the same dollar that we've been using since 71. And it tells us time and time again that that 103 line is significant. Look at last month, wick, and it closed below. Let's zoom in for some inspection. Wick, and it closed below. Wick, let's see if it closes below. We got a fair amount of time. It's not even halfway through the month. Close on the weekly. Look at these wicks. A breakout, invalidation. Wick, wick, wick. And yet we broke down, but we're pushing back up for a retest. This is a nice retest. We did not have. Look at that one. Look at that. January of 23. Look at that goddamn wick on 103. Look at that thing. It's remarkable. So I saw this price point because primarily of 2020, double wick, tweezy top, right into 103. You can't make this up. And if you carry the effects of that line to the present and into the past, you see interesting price action right around that price point. That's the deal. Nathan Paul Clark, sweet. I caught a live one. Much a pleasure. JW, cool. Iyad, good morning. George, good morning, everyone. Thank you all for joining. Let's take a look at Japanese yen because if this thing punches upward in any meaningful way, that's going to put a lot of appreciative pressure on the dollar. This is dollar versus yen. I don't know where things are going to head, but there's odds. It's all about statistical odds. And if we see the dollar significantly appreciate, that's going to cause a lot of commotion around the world. And it causes countries to fail and a significant amount of instability, which plays into geopolitical considerations. If you have economic crisis in Japan, who has bought the vast majority of U.S. debt over the decades, the last couple of decades? Japan, because of the carry trade. They could borrow cheap in Japan, buy dollars, buy treasuries. So if the dollar comes down in a meaningful way because of geopolitical manipulation or collusion, as I say, then you could borrow cheap and yen could still buy decent amount of dollars to buy bonds. If you're borrowing at a 0.5% or 1% in Japan and you're buying U.S. bonds for 4%, there goes the yen into the dollars, into the bonds. That's why Japan buys the bonds. That's called the yen carry trade. And if that unwinds the yen carry trade, that results in a tremendous amount of U.S. debt selling, which means yields just go absolutely vertical, and we attain an ever increasingly unsustainable fiscal situation regarding our capacity to service these debt instruments. JW Incredible 103. I took a note and we'll investigate it. It's written all over that chart from a decent time horizon, the monthly, and more importantly, if you look at like the 3 month, look, I have the white lines on here merely because of like harmonic cyclicality, and it would make sense for this giant tweezy top from a 3 month perspective and from a 6 month perspective for that to be a top. That's one heck of a shooting star. So this is my favorite chart in all of crypto. It's the DXY on the 6 month. This tells me the cyclicality that I want to see. This chart right here. If we see a top here, because cycles will cycle, and this cycle right here could take 15 years to play out, 15 years of dollar depreciation. That's why it's the most fascinating, because here's your two circles of bullish market conditions in the crypto space. So if you see 15 years of dollar depreciation, it's going to get perverted from a sovereign debt perspective, but it's going to play out from an asset price point inflation perspective. Assets are going to go absolutely vertical. What happens when assets go absolutely vertical? Disparity rages. The folks that own assets have significantly more access to capital as compared to folks without assets. So you get the disparity with folks that are just living on paychecks, and that is the prevailing directionality, the way the system has been for a long time, and it's just gotten even more and more exacerbated in recent time. curve, punch down to 58. Go out to the daily. So I don't trade much. I like to look at levels to really understand things from a geopolitical perspective, to understand directionality in the next 3 months, 6 months, 1 year. Um, so which means I do look at levels, and this is a pretty interesting level. Daily's not too interesting. If you zoom out to like the weekly, that's the monthly. Let's go to the weekly. It's an interesting level. It's not down. So to me, that's quite interesting. Still a fair amount of short interest open. Looks like there's 45 mil, which means there could still be a fair amount of a short squeeze. 45 mil being forced to purchase could finally push us back over the TWAP on the weekly, which isn't that significant. We breached the TWAP on the weekly, but couldn't push higher. If we put the SMAs up, you want to see at least a 50 SMA breach. So from a weekly chart perspective, we had our first interactions with the 50 SMA in a long time. Previous interactions were a breakdown, a retest, and a lower low. That's the trifecta of bearish confluence. Breakdown, retest, and then the lower low. The second you hit that lower low, there's your confirmation of trajectory. Undo. So this is our first interaction or attempts to push through the weekly 50 SMA since the retest failed in April of 22. There's your time horizons, April of 22, and then we first tried to break out in February of 23, which is almost a year. It's 8 months, 9 months, whatever it is. Then a second failed breakout, then a third, and that was blocked by the TWAP back here. And now we'll see what happens. But look, all that bearishness of the liquidation event couldn't break lower than the bearishness of the liquidation event when we had that event on Aave, when what's his name, forget his name at this point, was trying to force liquidate everyone, and he was doing what he was doing on Aave. It didn't get to the 40 cents, but interestingly enough, OTC was at 40 cents, and look at that bottom. The bottom in November of 22 was 40 cents. So that's interesting observations of data. And what does this look like? This looks like a nicely structured inverse head and shoulders still. I would have loved to see this wick hold at around 56 cents. That's still a nice inverse head and shoulders. Still a bit of a neckline. So that's pretty cool. And we're nowhere, we're near it. The initial lows from the hyperinflationary decay, post-launch, the initial decay. But look, these are lower bounds. This boundary, this area right here, rectangle. I don't know, I'd say TWAP and down. And of course, there's no transparency. Okay, so this region here, look at all the support here. Look at all the buying power. There was a hyperinflationary decay, and there was buying support here, and then here again. And now we're back here. Support, 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 support. So this is a very interesting region of support, especially considering macroeconomic conditions and the overall liquidity composition in the crypto space and the negative sum game that we're in. This is still showing as a significant region of support. Captain, do you know if cross-border capital includes stablecoins in his liquidity models? No. It's irrelevant because it's microscopic. There's almost no stablecoins in this space. This is zero. 123 billion in all, but mainnet is really what counts as inspecting as you would an emerging market. The $66 billion. So when he shows his data about overall liquidity conditions, $66 billion is zero. So you have to inspect this with that in mind, that this is all testnet. Everything that has occurred since 2020 is testnet, and that's it. You've been inspecting new software and speculating on the emergence of a reason why there would be significant capital inflow into this emerging market, and that's why we look and inspect The stickiness, the fact that there is $66 billion means what? This isn't total tether. This is total um, supply of stablecoins in DeFi on the Ethereum network, not like Tether on exchanges or USDC or whatever, wherever the liquidity is. This is on Ethereum mainnet. That's why this page on DeFi Llama is meaningful. It tells you the amount of currency units that are in this emerging market. And if you go back to 2019, it was $1 million in the emerging market. There was many more Tether and USDC back in 2019, but in DeFi there was no DeFi. The only DeFi there was Uniswap, and there was nothing. There was no market at all. There was no capture. But now this chart indicates dollar capture within this system. So that should give some insight into when you look at Mike Howell and Cross Border Capital's data, that this is not even remotely on the radar from a structural standpoint. Saw some stuff that Frax is doing, interesting stuff. Frax is the biggest scale and scope initiative in all of this space. Frax Chain, denominating their Ether being FXS ETH, FRX ETH. That's crazy. So scale and scope, monumental. Cash flow, complicated. Makes the XYZ equation that I talk about not necessarily favorable, because there really is no Y, at least not a significant Y. So any allocation is speculating on future cash flow potential, considering the equations that we talk about with regard to portfolio composition. So size the position accordingly. Or maybe not at all. If you're not getting cash flow, it might not contribute to what you define as the needs of your portfolio. And for me, that's critical. It's all about cash flow. And I think that will guide us into where the capital will flow into the future cycles. Capital will flow to where the cash flow is. That's why yields are what they are. That's why yields do what they do in the bond market, and why dividend investors historically engaged with markets the way they have. Search for yield. It means everything. Let's wrap it up for today. I appreciate all of you. No other points that catch my eye. Noah looks like it's doing well, and that's interesting. That's a high scale and scope market. There's a lot of folks that still have it very cheap from Solana days. Let's take a look at the chart real quick. But there's a lot of efforts behind the scenes, so that's interesting. Did hit 236 on the Fib retrace. Did hit 382 as a higher low. Structurally, maybe a bit of a cup and handle here. Inverse head and shoulders. Looks very nice. But just keep in mind, it's relatively expensive compared to what folks brought it over from YOLO, from Solana as YOLO. They were in much cheaper, 15 cents. So there's plenty of reasons for selling opportunistically, not really forced selling. That's what's most interesting. It's not forced selling. The amount of capital in these markets, there's no forced selling to be had. It's not exposed to those macroeconomic pressures. So you could very well have outperformance during macroeconomic liquidity events in very isolated markets. And that's generally my sentiment for the entire crypto space, for what it's worth. Thank you all for joining. Tell everybody to subscribe. Link to our Rational Discord is in the description below. I appreciate everyone in there. I think we make better decisions when we talk together, which we've done for years at this point. And I think we'll be well prepared for upcoming cycles. I will see you guys again on Wednesday. Y'all have a good one now. Peace.